Howdy, I'm Sean Pruitt. I made my first oil investment 30 years ago, and I've learned a lot since then. You know what I've learned after looking at hundreds of oil deals? The best investments aren't the ones promising to hit a home run. They're the ones where someone already hit a home run right next door and left money on the table. That's exactly what we found in Cattaraugus County, New York. Today, I'm going to show you why drilling $185,000 well can outperform an $8 million well and why the location we chose gives us an unfair advantage over the rest of the industry. But first, let me give you some context about the U.S. oil industry that explains why we are drilling here. Here's a surprising fact. 70 to 80% of the more than 900,000 oil wells in America are what's called marginal wells, producing 15 barrels per day or less. The average oil well in the U.S. produces just 26 barrels per day. And here's the problem. Most of those wells cost millions of dollars to drill. Shale wells in the Permian Basin, they need $62 to $70 per barrel just to break even. Bakken Shale, $79 per barrel break even. Eagle Ford, $84 per barrel. Do the math on that. You spend $8 to $12 million drilling a shale well. You need oil at $75 per barrel just not to lose money. And you are competing with every major oil company in America for drilling rigs, frack crews, and equipment. Now look at what we are doing. We are drilling shallow conventional wells for a $185,000 turnkey, not millions, $185,000. Here's what makes us powerful. We can prosper with just 5 barrels of oil per day. Let me show you the math. 5 barrels per day times 365 days equals 1,825 barrels per year. At $60 oil, that's $109,500 in annual revenue. That's 59% gross return on your well cost in 1 year at today's low oil prices. And here's an even simpler way to think about it. For every 1 barrel of oil per day at today's low $60 oil price, you are generating roughly 11% gross annual return. 5 barrels a day, that's 59% gross return. 10 barrels a day, over 100% return in the first year alone. And here's the advantage nobody talks about. New York State doesn't allow horizontal shale drilling. What does that mean for us? We are not competing with ExxonMobil or Chevron for drilling rigs. We're not fighting with major oil companies tying up 100,000 plus acres for decades. We're not bidding against deep-pocketed companies for equipment and frack crews. The major operators can't play in this sandbox, and that leaves opportunity for us. We own our own rigs. We're not waiting in line. We're not paying inflated rates. We control our drilling schedule and our cost. Low competition for leases, low competition for equipment, our own rigs reducing cost, shallow wells with low operating expenses. We are drilling in an area where the economics work at $50 oil, not $75 oil, where your well costs are $185,000, not $8 million, where 5 barrels a day generates 59% gross return, not break even. That's the difference between a marginal investment and a profitable one. Imagine a 6-layer cake. Now imagine someone taking just one slice from the top layer and walking away. That's literally what's happening in our project area. Let me show you real numbers. There's a well 1,500 feet from our property called the Kodiak K1. The geologists logged that well and found 81 feet of oil-bearing sandstone across 6 different formations, 6 layers of cake. They completed 12 feet, 1 layer, 1 zone. At that single 12-foot zone has produced 3,556 barrels of oil, made money, still producing today after 11 years. Here's the question. What about the other 69 feet? That's not speculation. That's hope. That's logged, proven oil, bearing rock that nobody has touched. And this isn't just one well. There are 6 wells in the Kodiak field right next to us. Every single one completed just 1 zone, all of them profitable, all of them leaving 5 more zones untapped. Now, Let me teach you how we find projects like this because understanding the process helps you understand the risk, or really the lack of it. Rule number one, we don't drill where nobody else is drilling. Now, I have the advantage of seeing a lot of opportunities. Over the years, I've built a network of over 30,000 connections in the oil and gas industry, operators, geologists, investors, service companies, all sharing what they are working on. Because of these relationships, I get sent hundreds of oil and gas deals, and there's something crossing my desk: a new play in Oklahoma, a workover project in Texas, an offshore opportunity in the Gulf. I look at a lot of deals and I pass on most of them. What I'm looking for is what I call pattern drilling territory. Think of it like this: would you rather open a restaurant on a street where every restaurant has failed, or on a street where every restaurant is packed every night? Pattern drilling means the pattern is already proven. Wells are producing, companies are making money, the formations are consistent. This area, over 350 producing wells in the 5-mile field, wells producing since the 1950s, multiple operators actively drilling today. Nobody drills wells that don't work for 70 years. Let me show you what convinced me with actual production numbers. The Kodiak K1, drilled 2013, produced 2,254 barrels in its first 24 months from just one 12-foot zone. That's 73% of your investment back in 2 years at $60 oil. Total production to date, 3,556 barrels and still producing. Kodiak K6, drilled 2023, has produced 2,075 barrels from 2023 through 2024. Same story, one zone only. That's 67% return in less than 2 years. The Kodiak K5, drilled 2023, has produced over 1,710 barrels from 2023 through 2024. One zone, 55% return. Here's what's important about these numbers. Even the lower performer K5 gave you more than half your money back in under 2 years from one zone out of 6 available. That's consistency. That's not luck. That's a blanket formation you could count on. And the 2015 wells, K3 and K4, are still producing after 9 years. From a single zone, total production 1,738 and 1,840 barrels respectively. Think about that. 9 years of production from 9 feet of pay when there are 70 plus more feet of pay sitting right there untouched. Now, I want to show you something that demonstrates what we are after. There's another field nearby called the Potter Field, drilled in the 1980s. Same formations, but they completed 3 zones instead of 1. Let me show you the difference, and I'm going to use first year numbers so we're comparing apples to apples. Potter Well C15 completed 3 zones. First year production, 3,781 barrels. That's 123% return in year 1 at $60 oil. Potter Well C3, 3 zones. First year, 2,833 barrels, 92% return. Potter Well C16, 3 zones. First year, 2,832 barrels of oil, 92% return. Potter Well C17, 3 zones. First year, 2,056 barrels, 67% return. Now compare that to the Kodiak wells with one zone. K1, first 24 months, 2,254 barrels. We'll estimate first year around 1,600 to 1,700 barrels. See the pattern? 3 zones gives you 2,800 to 3,800 barrels in year 1. One zone gives you 1,600 to 2,000 barrels. Now here's what you need to understand. Those Potter-filled wells used old 1980s technology. They fracked 6 stages total. We're fracking 16 stages across all 6 formations. But even with old technology and only 3 zones out of 6, they significantly outperformed. So here's the logic. Follow me on this. One zone equals good returns. Kodiak field proves this 55% to 73% in 2 years. 3 zones equals excellent returns. Potter field proves this 67% to 123% in 1 year. We're completing all 6 zones with modern frack technology, twice the frack volume, and wider well spacing for better drainage. We're not reinventing anything. We're just doing what should have been done in the first place. Now, you can have the best geology in the world, but if you don't have the right team, it doesn't matter. Let me tell you about the two people behind this project. Our consulting geologist is James Fowler, 30 years in the industry, worked for Marathon Oil and Hunt Oil Company. He's logged and analyzed over 300 wells in this specific area. When I say he knows these formations, I mean he knows where they are, how thick they are, and what they produce by heart. James doesn't just look at one well. He correlates entire fields. He can tell you what the Bradford Third looks like 3 miles away and how it'll look in our wells. That's not guesswork. That's pattern recognition built over 3 decades. Our operator is Vertical Energy, run by Stephen Ford. They're headquartered in Sugar Grove, Pennsylvania, right on the New York border. Vertical Energy has drilled and operated over 1,500 shallow wells in this exact region, not in Texas, not in North Dakota, right here. And here's what matters. They're currently drilling right now in projects surrounding our current Slocum oil project with similar results to the field history. The Wing Hollow field, 40 wells drilled. During the 12-month construction and completion phase, they've already produced over 30,000 barrels of oil. West 5 Mile project, 35 wells, which are almost completely drilled. We're seeing very similar results to the Wing Hollow in the historical field data. Between these projects, we currently have 75 wells producing oil right now. They are not just talking about drilling, they're turning wrenches every single day. This is their backyard, and they know the drillers, the frack crews, the completion teams. Their cost per well is lower because they are doing volume. Experience equals lower cost equals better returns for you. So why Slocum Hollow specifically? 3 reasons. First, location. We're surrounded by production, Kodiak Field to the south, 5 Mile Field to the east, Potter Field 1 mile south, Wing Hollow Field to the west. We're not exploring, we're developing. Second, the spacing strategy. Most wells in this area are drilled on 4-acre spacing. We're using 5.5-acre spacing. Why does that matter? Because when you frack a well, those fractures extend 300 feet or more. On 4-acre spacing, your fracks can interfere with the next. You are essentially stealing from yourself. At 5.5 acres, each well drains virgin rock. No interference, no overlap. Maximum recovery per well. Third, the completion design. This is where it all comes together. 16 frack stages across 6 formations. That means every productive zone gets properly stimulated. Nothing left behind. Remember, Kodiak does one zone and returns 55 to 73% in 2 years. Potter did 3 zones and returned 67 to 123% in 1 year. We're doing all 6 zones with modern technology. The math isn't complicated. More pay zones fracked properly equals more oil recovered per well. Now let me be crystal clear about what you're actually buying here. This is 30 wells, 30 units available. Each unit is $185,000. Here's what one unit gets you. 3.33% working interest in the entire 30-well project. That means you own a piece of every well, not just one. 2.5% net revenue interest. That's your share of actual revenue. And here's why that structure matters. Instead of being exposed to just one well that might be the worst performer, you own a piece of all 30 wells. You get the average, you get the good ones, and the okay ones. That's diversification built into the structure. Now let's talk about the economics at $67 per barrel of oil. Our projections show 100% return in approximately 14 months and 200% return in approximately 48 months. But here's something important you need to understand about oil prices. Over the last 2 decades, the average oil price has been around $80 per barrel. Right now, we're at 67. What does that mean for you? You're buying in at the bottom development cost. You're buying in at the bottom. Development costs are low right now, but here's the good news. Every barrel of oil you produce is sold at current spot price. So if oil prices go up to $75 or $80 or higher, your revenue per barrel goes up immediately. Your costs are locked in at today's prices, but your revenue adjusts with the market. You're locking in low cost while oil is at multi-year lows. When prices rise, and historically they do, your returns improve automatically. And here's the conservative part. Those projections are based on actual production from Potter-filled wells that only completed 3 zones. We're completing 6. Now, let me explain something that makes this even more attractive. The tax treatment. Oil and gas drilling expenses are 100% tax deductible in the year the wells are drilled. Let me be clear about what that means. If you invest $185,000, you get a $185,000 tax deduction. You can write this off against W-2 income, 1099 income, capital gains from real estate, capital gains from stocks, capital gains from crypto, essentially any passive or active income. This is one of the last true tax shelters written into the tax code, specifically designed to encourage domestic energy production. Now, I'm not a tax advisor, and you need to talk to yours about your specific situation, but this deduction can significantly reduce your actual out-of-pocket cost in year 1. The tax benefit is real, it's immediate, and it's substantial. Let me bring this all together. The investment thesis is simple. Wells right next door are producing profitably from 1 zone out of 6 available zones. We're completing all 6 zones with better frack technology and smarter well spacing. The geology is proven. The formations are consistent. The operators are experienced and actually drilling in the area right now with 75 wells already producing. This isn't a wildcat well in an unproven area. This is a pattern drilling in a field that's been producing for 70 years. Here's what I always say. The lowest risk oil investment is the one where you already know what's down there. You already know it produces, and you already know it makes money. The question isn't, will we find oil? We know the oil is there. It's logged. It's proven. The question is, how much more can we recover by doing it better? And based on the Potter-filled results, where 3 zones gave you up to 123% returns in year 1, versus Kodiak filled with 1 zone giving 55 to 73% returns in 2 years, we have a pretty good idea. Look, I'm not going to tell you this is a guaranteed home run. No investment is. This is oil and gas. There are always risks. But after looking at hundreds of deals and passing on most of them, this is the kind of project I invest my own money in. Proven formations, experienced operators, conservative projections based on actual nearby wells. You're buying in when oil prices are near multi-year lows, and you have a built-in advantage because we're completing zones that everyone else is leaving behind. Sometimes the best opportunities aren't about discovering something new. They're about finishing what someone else started. If you want to learn more, we are here to help you understand this completely. You're welcome to speak directly with James Fowler, our geologist, to review the well logs and discuss the formation in detail. You can talk with Stephen Ford and the team at Vertical Energy about the operations, drilling schedule, and completion plans. And if you want to see this with your own eyes, we could arrange a field visit so you can see oil actually flowing from the 75 wells that are already producing. Because the goal isn't just to get you to invest. The goal is to get you to understand exactly what you are investing in. We believe in transparency. We believe in education. And we believe that informed investors make the best partners. If you wish to learn more, reach out to me either by phone or look in the comment section below. Thank you, and we will talk soon.